Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies, Tesla stock, as well as NIO stock. In this video, we will be analyzing a plethora of articles, to where the first one is titled, Why the Market is Skeptical of SoFi Right Now. So we'll be discussing why SoFi Technologies has not surged yet, and why the market is so skeptical about this company even though their overall fundamentals are extremely solid. After that, we'll move on and we'll talk about how Tesla has had an amazing winning streak regarding how their shares have increased for the past multiple trading days in a row, but a pullback is imminent. So we'll be going over their latest price targets and catalysts in this video so you can see just how fundamental and solid this company truly is, as well as their future growth projections. On top of that, we'll talk about how Cathie Wood from Ark Invest believes that Tesla will become one of the top 5 largest companies in the entire world by 2030 and eventually overtake that #1 spot to become the most valuable company globally, which is absolutely fantastic for TSLA stockholders and Tesla investors. After that, we'll be moving on and talking about how Tesla will eventually be coming out with a $20,000 to $25,000 electric vehicle, and I'll discuss exactly how they plan to do this. We don't know officially when this will happen or how they will achieve this, but the author of this article, as well as myself, do have a very good educated guess on how this is going to be rolled out. After that, we'll talk about a little bit of Tesla's competition in their autonomous vehicle and AI driving space, and then lastly, we'll close by talking about why NIO shares have dropped by more than 10% today, despite them having a catalyst to where they are hosting their all-new ES6 launch event over in China. So for more news updates on SoFi Technologies, Tesla stock, as well as NIO stock, don't forget to go and annihilate that like button right now. Go ahead, obliterate it right now. I'll wait because it helps me out a ton. Don't forget to subscribe to the channel for more videos just like this one, and if you want to support me personally and keep me here on YouTube, don't forget to click on that join button right next to the subscribe button to become a member of this channel to support me personally for as little as just 99 cents, so you won't even feel it. It helps me out so much, and that's what keeps me here on YouTube making videos for you. But with that being said, let's jump right into today's stories. SoFi Technologies, as you know, is a fintech company or a financial technology company which operates as a digital bank. And year to date, their shares have been up around 10.5%. However, despite this, the market has been worried about their growth going forward, particularly revolving around their personal loan portfolio and the risk that that adds. In previous videos, I have discussed exactly why I am not worried about this, but I really want to put to rest any skepticism or worry that investors have regarding their personal loans. Because just from the market, it's clear that investors are skeptical right now of SoFi Technologies. So to catch you up on this, essentially, SoFi Technologies originates personal loans and they keep them on their balance sheet between 6 to 9 months, and then after that time frame, they sell their loan to another financial institution. This allows them to do two things. One, it allows them to get money from the origination of the loan, as well as while it's on their balance sheet between 6 to 9 months, they get to acquire revenue because they are getting interest income from these loans. However, they then proceed to sell the loan after 6 to 9 months, in which they make money from the sale of those loans, and they no longer have the risk of holding those loans on their balance sheet just in case the borrower defaults on the loan or can't pay it, meaning that SoFi will have to float the bill for this loan, taking away money from SoFi Technologies. However, lately, SoFi has not been following this model because they have not been able to sell their overall loans. They have kept these loans on their balance sheet for multiple quarters, meaning that although yes, they are getting interest income from this, they do run the risk if anyone were to default in these loans or not be able to pay it back, SoFi is floating the bill for that. So once SoFi holds these loans until maturity, they are also going to have to set aside revenues in case any of these loans turn out to be a loss, which is going to negatively impact their overall earnings because they have to put revenues aside for this. This ultimately could prevent SoFi Technologies from becoming profitable by the end of this year, and that is what investors are worried about. They're worried about SoFi not necessarily meeting their end-of-year prediction of becoming profitable, or it's really going to hurt the company if a recession occurs and people get laid off from their jobs and they can't pay back their personal loans, meaning that SoFi could go underwater from this. At least that's the bearish argument in regards to these personal loans. However, I see it as the exact opposite. SoFi Technologies is making loads of money by not only originating these loans and collecting interest income over the term or duration duration of the loan, but even when these loans come to maturity, they get a longer time period of getting that interest income now, although it is higher risk. So I actually think this is going to increase their overall revenues, which could offset the amount of revenues that they're going to have to put aside for potential loan losses, meaning that it's not necessarily going to impact their overall year-end predictions. Right now, SoFi Technologies trades for $5.18, while bearish analysts and professionals believe the company could drop down to a price target of $2.50. However, very bullish analysts think the company could surge up to $10 by year's end. For me personally, as you all know, I have an $8 price target over the next 12 months for SoFi Technologies, and I myself only have a 4% allocation to this company as of right now, but if it drops below $5 per share, I will add more of this company, getting my overall initial allocation to a 5% allocation for this company. But I don't advocate more than a 5% initial allocation to singular risky growth stocks, because that means you're taking on unnecessary risk of potential losses, and it's just improper risk management. In a previous video, I stated I'm not worried about SoFi keeping these loans on their overall balance sheet, because the people who have these loans are extremely high earners who have good credit scores. For instance, the weighted average income and FICO score for their personal loan borrowers are $164,000, and these borrowers have a credit score of 747, meaning that not only are they very responsible fiscally, but they also make loads of money. So the chances of them defaulting and not being able to pay back their loans, or even losing their job during a potential recession, is extremely low, and that's why I am not worried. So I want to officially put this overall skepticism to rest. Also, I want to say how the CEO and other institutions are buying SoFi shares right now. So if this risk was truly that prominent and detrimental to the company, clearly other institutions and the CEO wouldn't be buying so heavily right now. The reason they're buying is because they believe the company is undervalued right now, and how the future share price could be substantially higher than the current share price. Again, my price target is $8. So I just want to officially put that to rest to try to calm investors' nerves surrounding SoFi Technologies. Again, this is a long-term holding opportunity, and I look forward to see if the company can actually achieve profitability by the end of the year, which they are on track to do, which should act as a phenomenal catalyst, causing the overall share price to increase. But now let's talk about Tesla stock. And as you know, Tesla is an electric vehicle company that focuses on energy storage as well as energy generation. And investors for Tesla are very euphoric right now because they have had multiple positive trading days. For instance, over the last 6 trading sessions, the stock price of the TSLA shares have increased by 12%. And the main reason for this is due to their gigafactory over in Austin, Texas, receiving very positive sentiments from professionals. As an example, an Oppenheimer analyst recently reviewed Tesla's Austin gigafactory, and he wrote a research report telling us how impressed he was. And he says, and I quote, "With Austin production clearly accelerating from March Analyst Day levels, we see Tesla investing in important innovations to enable scaling, increase simplicity, and geopolitical de-risking of its supply chain." End quote. So this is a very positive update for Tesla shareholders and Tesla as a company. On top of that, Tesla has also recently broke ground regarding their own lithium refining operation, meaning that Tesla is going to be self-sustaining eventually, because globally, most lithium, which is a key component for electric vehicle batteries to make electric vehicles, is refined in China today. But if Tesla has their own operating facility for lithium refining, they are going to become self-sufficient in this area. That's why the analyst also comments how Tesla is well ahead of their overall competition, which we will talk about a little later in this video. And I also want to mention how this particular analyst is not a Tesla bull. He is more neutral, and he does not give us a share price target for Tesla shares. Currently, the price of Tesla has pulled back slightly to $180 right now, but despite this, analysts overall are still extremely optimistic on this overall company. For instance, the low-end analyst price target comes in at around $181, meaning that arguably this company is undervalued right now. However, the most bullish price target for the company comes in at around $280, and me, for myself, I personally gravitate more toward a $250 price target for Tesla's TSLA stock. I also want to make investors aware how a Citigroup analyst also commented on the immense technology that Tesla has put into their gigafactories, and he also commented on their Shanghai gigafactory over in China. The analyst said that according to Tesla's data, Tesla sold 10,200 cars in China between May 15th and May 21st. And although that's only a week of data, we can estimate this out for yearly production numbers to where their units could be selling around 500,000 electric vehicles over in China, thanks to their Shanghai plant, which is producing around 18,000 vehicles per week. Also, Tesla is shipping out some of these vehicles, which are made over in Shanghai, to Europe as well as Canada. China, if you didn't know, has the largest market for new cars as well as electric vehicles, to where about 4.6 million battery electric vehicles were sold in China in 2022, compared to only around 810,000 sold in the United States. So the fact that Tesla has set up shop over there as well means that the future of this company looks extremely bright. But the news for Tesla gets even better, because Cathie Wood of Ark Invest predicts that Tesla will become one of the top 5 most valuable companies globally, and eventually they will become the #1 most valued company in the entire world. Cathie Wood of Ark Invest has been a huge bullish proponent of Tesla, and her largest position is in this company. And she actually believes Tesla is the best, or at least one of the best, artificial intelligence companies. Despite Elon Musk calling for a temporary moratorium on AI development to halt this, to really think about what we're doing, Tesla has actually become a major player over in the artificial intelligence field. And with their cutting-edge technology, they could become one of the most valuable companies globally, and here's why. In a recent interview with Fox Business, Cathie Wood of Ark Investment Management said that Tesla will become one of the most profound AI or artificial intelligence companies out there. She labels Tesla as a technology company, and she argues that the major artificial intelligence and machine learning innovations regarding Tesla's autonomous taxi driving technology is going to catapult Tesla to one of the most lucrative companies on the face of the earth. Tesla has already developed chips, neural networks, code, and evaluation infrastructure to make self-driving cars which can drive themselves completely autonomously a reality as soon as 2024. Cathie Wood also describes how these autonomous vehicles will be used as taxis for a ride-hailing service, to where instead of requesting a Lyft or an Uber, you can request a Tesla vehicle to come and get you and drive you to your destination with no driver needed. You will literally just be a passenger. And Cathie Wood says this is the biggest opportunity in artificial intelligence over the next 5 to 10 years. Moreover, she adds, if Tesla achieves this, they could become one, if not the largest and most valuable company in the entire world, meaning that the share price would absolutely explode past $2,500 by 2027. But with this being said, I also want to talk a little more about this artificial intelligence technology and how this could lead to Tesla coming out with a $20,000 to $25,000 electric vehicle. Theoretically, Tesla could sell their vehicles for a zero profit margin on purpose, and here's why they would do this. Although Tesla does receive a gross margin of around 19.3% by selling their electric vehicles, which is far more than any other automotive manufacturer, Tesla actually may want to sell their cars for no profit, and here's why. Number 1, Tesla's software products actually carry a much higher gross margin between 70 and 80%. This means although they can sell their vehicles for cheap between $20,000 and $25,000, they are actually looking to make the majority of their money from a subscription service regarding their autonomous vehicle driving technology, which has far greater margins. So the ability to sell Tesla for cheaper means that more people will be buying their vehicles, and thus more subscriptions, which has a far greater gross margin than their 19.3% margin compared to their 70 or 80% margin that is literally annual. This 19.3% margin is a one-time thing once someone buys the car, but these subscription-based margins will be yearly margins, or at least could be yearly margins if they adopt a subscription model. The second reason they could do this is they could essentially put other automotive companies out of business. For selling electric vehicles so cheap, literally no other company could compete with Tesla at that price point, to where it would force other companies to sell their vehicles either below margin or barely above margin, potentially putting them completely out of business. And once these companies go out of business, people will be forced to buy more Tesla cars. And last but not least, with more demand due to these cheaper prices for their electric vehicles, this would also mean that more robo-taxis will be available worldwide, which would replace the revenue that they got from their initial selling of the vehicle if they decide to sell them for zero profit now. So essentially, they would be willing to sell cars for a zero profit on purpose to essentially sacrifice the 19.3% margin in exchange for the 70 to 80% margin on top of the revenue that their fully autonomous self-driving software and taxi service will more than make up for. So overall, this is very exciting news regarding how Tesla could come out with electric vehicles as cheap as $20,000 to $25,000. However, Tesla is receiving competition in this overall area from Google and Uber. For instance, Uber also offers ride-sharing and ride-hailing autonomous driving services, or at least that's their plan in the future, and they recently signed a contract and teamed up to partner with Waymo to produce robo-taxis to compete directly with Tesla. If you're not familiar, Waymo is actually a subsidiary that is under the Google umbrella, so Google, with all of their artificial intelligence technology and all of their data from Google Maps, as well as Waymo's own technology for autonomous driving, they are going to help Uber make robo-taxis a reality to directly compete against Tesla. Although clearly there is room in the market for both of these giant companies, but this is a huge step forward for Tesla's overall competition in regards to Lyft, Uber, and Waymo, especially since they are integrating their technologies together to try to dethrone Tesla before Tesla gets the first mover advantage. Last but not least, let's talk about NIO shares, ticker symbol NIO, which has dropped by around 10%, which is quite surprising because NIO is a Chinese electric vehicle maker that sells premium smart electric vehicles, and they are actually going through a catalyst right now because they are hosting their all-new ES6 launch event over in China. The reason why the share price of NIO as well as other Chinese EV makers are decreasing right now is because future projections for companies like XPeng and NIO have readjusted their forecast to sell less electric vehicles thanks to the immense competition over in China. So, although NIO as well as other EV makers are getting cheaper in their overall share price due to this very negative update about them changing their overall vehicle forecasts, again, I want to remind people who have invested into NIO, NIO is already trading at an extremely cheap valuation, and they are not supposed to be profitable until 2026 if they make it that long without going out of business first. However, I believe that they will really impress investors after the third quarter of 2023, and after the second quarter of 2023, that's when the company will actually start selling and implementing their overall plan. So although this is going to be a minor setback for EV makers in China, now a very smart investor may want to wait until this company becomes profitable before investing to lower their overall risk. But with that being said, I'd love to hear your thoughts down below about SoFi Technologies, Tesla, Ark Invest, and Cathie Wood, as well as NIO stock. Go ahead and annihilate that like button if you haven't already. Subscribe if you're new. Comment down below your thoughts. Don't forget to become a member of this channel to support me personally, and I will see you in the next YT video.